Hi, and welcome back. Today, we're going to continue our discussion on the topic of EBITDA. To recap our last video, EBITDA is a measurement of a company's operational profitability. It is so fundamentally important because it is an easy measurement of a company's cash flows and is used almost universally by private equity investors to measure the value of a company. If EBITDA is such an easy concept, why do I hear the following question all of the time? Well, buyer A says my EBITDA is X, and buyer B says my EBITDA is Z. Why the difference? It all comes down to the adjustments that a buyer is making to a business's profit and loss statement. Since we're all in the business of dentistry here, I'm going to be talking about EBITDA adjustments through the lens of a dental practice. When transitioning a dental practice from owner-operator to being owned by an outside investor, there are a few common adjustments that any investor or buyer will make to a practice's P&L. Common P&L adjustments include things like adding back personal expenses. Car, personal cell phone, personal travel always get added back. Sometimes there are payroll adjustments. There are family members on payroll. Doctor compensation is almost always reset to a market rate. Certain overhead items frequently get added back. Things like business insurance, legal fees, accounting fees, and lastly, rent in certain circumstances is reset to a market rate. Okay, let's walk through a sample dental practice P&L statement. The following numbers are completely made up, but they'll help us illustrate some of the adjustments we might make to a practice's EBITDA. The adjustments I'm going to make in the first example should be simple, non-controversial. Here is an example dental practice P&L. The column to the left reflects the numbers provided to us by the practice owner's accountant. The middle column shows the adjustments that we're going to make, and the column to the right shows the final resulting number of each P&L line item. The first adjustment we're going to make here is to add back family that's on payroll. So staff salaries and wages is going to be reduced by $40,000. The second adjustment we're going to make is to eliminate the doctor's salary. In most cases, the practice owner's salary is completely arbitrary, and we're going to reset this to a market rate compensation anyway. The third adjustment is to reduce payroll taxes correspondingly with the reduction in salaries and wages. Next, we're going to adjust insurance. We're going to eliminate legal and accounting fees. We're going to reduce travel and entertainment, and we're going to add back practice owner's personal auto. Travel and entertainment can be a little bit tricky because in some cases it truly is a personal expense, and other cases it is a justifiable expense that is used for the staff. The next two adjustments we make are to eliminate depreciation and amortization. Those expenses are non-cash charges, and we add those back. The final expense on the P&L that we adjust is the interest expense. If you remember from our original definition of EBITDA, depreciation, amortization, and interest are all excluded from the calculation. Finally, we reset doctor compensation to a market rate compensation formula. In this case, we're assuming that the owner doctor's collections are $1 million from his or her own personal production, and we're paying that doctor 30% of what they collect. Therefore, the new payroll expense is $300,000. Lastly, there's a payroll tax increase with that new wage of $12,000. You can see all the adjustments tallied in the middle column, and on the far right, you can see that we end with a resulting EBITDA of $325,000 and change. Now, let's review a different example. In this next example, we're going to take a few more editorial liberties with the adjustments we make to EBITDA. This will be a more aggressive view of the P&L and will incorporate what finance professionals refer to as pro forma. Pro forma is a fancy term for predicting financial results using assumptions or projections. In other words, it's made up. Okay, let's get into some more adjustments. The first add back we're going to make here in example 2 is the same as the prior example. We're going to reduce staff salaries and wages. But in this case, we're going to be more aggressive and reduce labor by $60,000 instead of $40,000. Why are we doing this? Well, we're just assuming that we're going to be able to run this practice a little leaner and a little meaner. The next two adjustments we're going to make are truly pro forma in nature. We're assuming that we're going to reduce lab spend by $15,000 a year and supply spend by $30,000 a year. Really have no basis to make these adjustments other than that we're assuming going to have more buying power and we're going to be able to drive down the cost of the practice. Maybe we will, maybe we won't, but in this case, we just created another $45,000 of EBITDA. The next adjustments we're going to make are to travel and entertainment. Instead of keeping some of that travel and entertainment in for the team, we're going to add it all back, because why not? The second is to add back the car, same as the first example. The third is we're going to add back all continuing education. In this case, we're stripping the CE out of the practice budget, and that will become a doctor obligation going forward. But those combined adjustments create another $21,000 and change of EBITDA. All other adjustments to this P&L are the exact same as example 1, but you can see by some of these pro forma adjustments, we've now increased EBITDA to just over $404,000. In our third and final example, we're going to toggle two key expense items on the practice P&L: doctor compensation and rent. Doctor compensation and rent are frequently affected by market-driven factors. In this third example, I'm going to toggle the rent, and I'm also going to toggle the doctor compensation. You can see how changing these expense items further affect EBITDA. Doctor compensation and rent are frequently affected by market-driven variables. Because there can be subjectivity to these two line items, I'm going to create some changes on this next P&L so you can see how modifications to these two expense items ultimately affect EBITDA. In this example, we're going to increase the annual rent from $72,000 a year to $92,000 a year. That's a $20,000 increase to adjust the rent to market rate. You'll notice the change it makes to EBITDA. The second variable we're going to change is doctor compensation. Instead of using 30% of collections, we're going to use 32% of collections. You'll note there is similarly a resulting change to EBITDA. If you're selling your business, then of course you want the higher EBITDA. Assuming that the buyer will use the same EBITDA multiple in example 1 and example 2, the example 2 is going to yield the seller a higher valuation. The problem with example number 2 is that both the buyer and the seller are going to have to live with that pro forma expectation of the business going forward. This can have a long-term impact on the business. If the business is valued on a pro forma EBITDA expectation, there are two potential adverse outcomes. The first is that the new owners of the business may need to direct operational changes to achieve the desired financial outcome. The second is if that target pro forma cannot be achieved, then the investor has ultimately overvalued the business. In a vacuum, or on a one-off basis, this may not be the end of the world, but assuming a company has too many misses on their pro forma, they may ultimately threaten the health of their balance sheet. Here's an example to illustrate what I was just talking about. In example number 1, we use a multiple of 6x on our adjusted EBITDA of $325,000. Our resulting valuation is $1.95 million. In example 2, we're now using the pro forma EBITDA of $404,000. Assuming a 6 times multiple, our valuation increases to $2.4 million. Okay, let's assume under example 2 that the pro forma EBITDA did not materialize, but we're stuck with that $2.42 million valuation. That, divided by the $325,000 of adjusted EBITDA, now yields a multiple of 7.5 times, not 6 times. Why is this important? If you're selling your business, obviously you want to maximize the valuation that you're going to get. You can only do this in a couple of ways. 1, increase your EBITDA, or 2, increase the EBITDA multiple. What we were trying to highlight here is that you can artificially increase EBITDA, but doing so often doesn't leave the buyer and the seller in a good spot on the back end of the deal. No one wants to be on the opposite side of a transaction, trying to achieve a number that is simply not achievable. This generally does not lead to a good long-term result for the business. Join me next time and we'll talk about EBITDA multiples and how the capital markets affect those.